Amazon surging after hours. The conference call is underway. Let's get the very latest from Deirdre Bosa. Debo.
So, Melissa, they're just getting into the first question, but CFO Brian Olsavsky, who runs the call, started it off by talking about thanking employees and also talking about AWS, pointing out that it is now a $71 billion annualized run rate business, up from $51 billion run rate 1 year ago. That's AWS. He also called out Meta and a few others as long-term strategic customers. He also noted that there's now 1.6 million Amazon employees. That is doubling in a 2-year period. He also just spoke about that Prime price hike, and he's going through different offerings on the platform to justify that price hike, like Originals and, of course, Thursday Night Football. I will get back to this call and look at the questions and bring you anything as I hear it.
All right, Deirdre, thank you. Deirdre Bosa. Let's bring in Gene Munster, managing partner at Loop Ventures, for more. Gene, great to get your insights here. How should we think about the guidance? Because, I mean, the quarter looked fine. It looked great. I don't know if it looked up 20% or 13% great at this point, but that the Q1 guidance was a miss. And so why are investors looking past that?
Well, I think it's a reaction to the state of where the market was at. I think it's less about what the fundamentals are. I'm in the same camp as you, Melissa. If given this press release and asked what the stock would have done, I would have expected it to be down on this. And so I think you are seeing this bounce back. But my attention, as I start and listen to the call, shifts actually away from March into the June quarter. We now have March guidance, but the June quarter, CFO was just outlining some headwinds that are going to persist not only in March, but in June. For example, they've had this surge in unit growth that has created operating leverage, a positive leverage in their fulfillment centers. He said that that is going to start to moderate. Unit growth was only 3% in this most recent quarter. It will probably be flattish to down in March. And then you lose some margin, a positive tailwind. Also, this is pretty boring, but it is important. They're changing some of their depreciable life on their servers, which can have a little bit of a headwind to EBITDA in the March quarter. So to answer your question is, how do I feel about this? I start focusing on June, and I suspect that this 17% growth that the street has for the June quarter is probably a little bit too rich given some of the commentary.
Gene, it's Karen. Thanks for being on. I know there's a lot of pieces here, but how do you think about how to value this company? You got some great businesses and some low-margin businesses. Put it all together. What do you think it's worth?
Well, I think over the next few months, I think there's probably more downside than upside. And specifically, for me to get a good, solid view of what this is worth, I have to get a better understanding of what their operating model's at. And we continue to see these wild swings. We have to obviously back out what happened with Rivian. They guided lower for the EBITDA contribution for the March quarter by about 50% versus the street. That's what they typically do. But I don't have a good answer. I think that this is predominantly going to be still a theme-based stock. I think that to try to do some of the parts with their advertising business, I think that's probably why they're breaking it out, to give investors a little bit more framework to try to build a stronger valuation case here. But it still is rich, in my opinion. This is a great company long-term. This is a winner. They're on the positive side of the ledger when it comes to FANG. They're an infrastructure company. They're not a attention company like some of the other content related. So I'm a long-term believer, Karen. I'm not answering your question because I just simply don't have the guidance or the framework from on a earnings perspective to get a good, solid answer.
Gene, I'm just curious to get your thoughts on the huge swings that we're seeing in market cap for some of these big cap tech names. You're in big cap names in general. One is, in general, for some stability. And this is the exact opposite of stability, what we've been seeing in the past couple of days.
Investors want to sleep well at night. And I think that speaks well to why Apple is and will continue to do well, is that they'd been, I think, villainized for many years for having a hardware and software business. And here it turns out it's more of a sleep well at night investment. So I think that that's one of the key pieces here. And I think that part of the sleep well at night is this noise. There's the fundamentals that we usually have to navigate, but now we have the noise of the market. And what is a rule 1 minute is a different rule another minute. And I think I look to the Fed to help moderate this. I think when the Fed gives some more clear direction, and whether it's 5 rate hikes or 1 rate hike, it could be either of those. We're going to get some employment numbers tomorrow, but I think until we get some clear direction, one way or the other, from the Fed, I think the market is still going to be quite wild. And I would just kind of anchor back to what are the companies, the companies that are foundational. I think that Apple's a foundational, Google, the oxygen in the internet. Easy to say it after this earnings. I think Amazon long-term is one of those companies, but they've got to work through some pretty big headwinds in the first half of 2022 before I think there's some stability in their share price.
Gene, thanks. Gene Munster, Loop
Thank
Ventures.
You.
What, in your view, Dan, is foundational? I mean, it's an interesting notion that Gene puts out in terms of investors want to sleep well at night when they're investing in big cap stocks and big cap technology. So is what we've seen in the past couple of sessions make you think that Apple is much more attractive now, that Microsoft is much more attractive now?
Well, I understand why investors are flocking to them. They had good quarters and they had good guidance. The stocks have been relatively stable, especially relative to many of the other names, let's say, within technology or so. But I'll tell you this, if you were worried that 6 or 7 stocks 3 months ago were making up a majority of the performance, the S&P 500 and the NASDAQ, and they made up about 30% of the S&P 500 and 50% of the NASDAQ 100, you got to be more worried now, because we actually, and Gene just mentioned what the Fed, whether they're going to do 1 or 5 hikes, no one's going to know, and they're not going to tell us either. And if the assumption is that we're going to continue to raise into a slowing economy, and we've seen weaker data of late, well, then ultimately you're going to see Apple and Microsoft, you're going to see their business slow down a little bit. So to me, it becomes a bit more dangerous as you see more crowding in fewer names.